Well, I think really the main feature of what we're seeing in the markets is a major rise in confidence, not only in Australia, of course, but pretty much around the world. And really at the epicentre of that rise in confidence we're seeing is global central banks. So recently we've had comments from the US Federal Reserve's chairman and his successor, which really indicated to the market there's going to be complete policy continuity between Ben Bernanke and Janet Yellen. And that has been something which, of course, global markets have been very optimistic about, and we have seen prices rise quite aggressively of late. And that's evident, of course, by US markets rising up to all-time highs, and even the Australian market is up to a new all-time high on an accumulation basis. Now, the interesting thing is when you actually dissect the rally, the real missing variable at the moment is earnings growth. And really there hasn't been too much of an improvement in all essence in the global economy even. So at the moment markets are rallying very aggressively. There hasn't been a large follow through in the earnings outlook. And so in that way it's kind of like the one piece of the puzzle which is still missing. When we have a look at the market since September of 2011, what we can see, the US market has rallied 55% in price terms, yet earnings are up only 13% over that period. Whereas in Europe, and other parts of the world in the emerging markets in Japan, you put all those together, they're up 40%, whereas earnings are actually still down 5%. So really this, it's a very large difference between prices and earnings. And that's something that we just have to be aware of course, in our portfolio. So when we have a look at the market, investors might be looking, thinking it's a great time to get into the market. One thing we do have to keep in mind is that sort of outperformance of prices isn't really going to be sustained. So I think we're going to have a period of time when markets actually, earnings I should say, catch up with the markets. And the interesting thing is there's not really much you can see out on the horizon that would actually knock the markets off its pedestal. The Fed's saying that QE is going to remain in place, probably well into 2014. And really the RBA clearly isn't going to be tightening monetary policy anytime soon, even though we think we're pretty much on hold. So when we look at the markets at the moment, I think we're probably in one of these holding periods where it just gives corporations time to deliver the earnings growth that the market's now expecting. Earnings growth for this financial year, it's still pretty optimistic. We're seeing 12% earnings growth expected in Australia, 14% in the US, and these are in economies which are growing around 4 or 5% in nominal terms. So that is a very big difference, and I think in time we're going to see those earnings growths downgraded, but that doesn't necessarily have to be a big headwind for the market. So I think really when you look at the environment in its totality, what we can see is that it's really important for investors at this time to remain focused on those companies with rising earnings growth, make sure they've got a strong balance sheet, and I think they will be able to deliver the earnings growth through time that the market is expecting. Probably the worst thing the investors could do at this stage is actually start to get tempted, I should say, by rising share prices. We've got to make sure the focus is on earnings, not on prices. And that's what we continue to do, in our portfolio management of Perpetual, looking at those company balance sheets, those operating models, and just making sure we're happy with the stocks that we have in the portfolios. And in the end, it's really those wealth creation companies that really do increase the value of a portfolio through time.